Welcome back. You're still tuned into Trading Hour here on CNBC-TV18, and we have Vikas Khemani joining us from Carnelian Capital Advisors to take us through how he's really seeing the market from here on. Vikas, thanks a lot for joining us as always. You know, today, of course, the big cue that everybody is tracking and talking about is the Jackson Hole conference. What are your expectations from there? And, you know, considering that the data that we've, got is suggesting that maybe we could see a little bit of a hawkish tone, how much of that do you think is factored in?
Frankly speaking, I think you'll have to, of course, there's no point in guessing what is going to come out on that. But if you just look at the overall environment, of course, U.S. economy is holding on very well. But at the same time, the case for incremental aggressive raising of the rate is not there, in my opinion. So the balance has to be between maintaining growth as well as, taming inflation. And there are, of course, different reasons for inflation than only the monetary policy. So I think those have to be also addressed, and some part of the inflation is structural in nature. So I don't see very aggressive stance on being very hawkish, but at the same time, any comforting on cut side also is unlikely to come. So we'll have to wait and watch. I mean, we don't really spend much time in thinking around what's going to happen there, to be very frank.
Vikas, what about these EMS companies? Our colleague Surbhi was just telling us that Kaynes Technology is trading at more than 70 times FY24 PE. So FY25 would be a lot less. I was looking at Syrma SGS, and they're trading at more than a 50 times forward multiple, FY24, FY25 PE. But, Syrma SGS, for instance, has a target to achieve $1 billion of revenues by FY27-28, which would require the company to grow at a very, very fast clip. I think Nuvama estimates the company growing at 40% revenue, FY23 to FY28. Given that kind of growth and the current moat around these companies, do you think the valuations are justified?
I mean, I won't comment on a specific company, but generally I can tell you there are pockets in the market which get glamorized in terms of the potential growth and potential opportunity space in that. And since these are relatively smaller spaces with a few numbers of players, most people want to buy those companies. As a result of that, they end up becoming more and more expensive. And to justify that, most analysts end up building higher expectations of the growth. But the fact of the matter, the reality in life is that growth does not happen on the spreadsheet. It happens on the ground. And typically companies, find hard to meet those expectations, and that's why it is always followed by a bit of a disappointment. It happens in every sector. We saw that happening in chemical. We saw that happening in new tech. And I feel even in EMS space, there's a lot of fraud that is built. And I'm not specifically commenting on a particular company. I'm generally specifically saying that there I am seeing this and defense are the two spaces where I'm seeing a lot of fraud getting created, a lot of high expectation getting created, which probably may not be met in terms of actual delivery. So, one has to be very, very careful in those kind of segments and names.
Point taken, Vikas. We were just listening into the valuations when our colleague was discussing Kaynes, for instance. So that's a stock trading at 70 times. So, you have to be cautious. Absolutely no two ways about that. Let me just press on this point further. You mentioned there's froth even in defense. Now, we know, for instance, a lot of these space stocks, and these companies typically do both space and defense. Your MTAR, Astra Micro, a couple of others. I was studying a few of them just yesterday, Paras Defense, etc. Now, these stocks have also gone through the roof. But the rule in the market is just because something is rising doesn't mean that it will stop rising because of multiples. Now, either you can be in that camp and keep buying, leaving valuations aside. But for those who do want to, have some sort of a hold on valuations as well, what's a band? I mean, what is the new normal which still seems reasonable for these defense and space exploration companies?
See, first of all, let us be very clear. There's no new normal for a particular sector. Investing, whether it is equity or whether it is, this sector versus that sector, investing equity is same for everything, right? Ultimately, valuations are determined on 3-4 things, right? One is your returns on the capital. Secondly, growth in the earnings. Thirdly, your discounting factor, right? These are the broader things, the 3 things which determine. Now, suppose, let us say, if you have a high ROE company, high growth, expected growth in that sector, thereby you will see those companies trading at a reasonably, or segment of companies trading at a higher premium. The problem comes when there are companies with a lower ROE and expected high growth ends up trading at a crazy premium. Typically, some of them start getting, then they will sort of set themselves for a disappointment. The risk reward does not fall into place. So we are always very careful or wary of those kind of segments. The new normal, when it starts being called that defense is a new normal, actually it's a sign of euphoria, because then newer people justify new ways or new valuation, calling it new normal, and hence relative valuation kicks in. X company is trading so much valuation, so why should not trade, and hence why becomes cheaper. Those are the traps, I would say. Go back, and similar kind of conversation used to happen around new tech, right? And we have seen what has happened.
No, absolutely, Vikas. No, so let me change the phrase. Let's not call it the new normal. I mean, I'm not trying to justify the valuations at which any stock is trading. I'm just asking you that for, say, defense, what is a valuation band that you would be comfortable? So our viewers will have an idea whether you think that 30 to 40 times typically for stocks like these with these kind of gestation periods and ROE. What's a band that you would be comfortable with for both defense and even some of the new technology companies, because they've had a good run and they've started showing profitability? You know, your Paytm, Zomatos, and even PB Fintech for that matter. All these stocks have had a great 2023 so far. So these two segments, what are valuation multiple, rough ranges that you would be comfortable with?
We generally look at, I don't say that that's a right or wrong. I'm just saying what we look at it. We typically look at PEG go between 1 to 1.2 times max kind of range. Beyond that, we don't go unless we have a very strong reason that the current E is depressed for some reason, and and we have high conviction that this number is going to grow over next 2-3 years. Over big turnaround is happening. That's the time only when we ignore this PEG ratio. But on a steady state basis, I think between 1 to 1.2 times of PEG ratio is what we typically look at. Beyond that, it's in a risky zone. We are very clear in investing. Risk reward matters a lot. It has to be in your favor when you invest. Otherwise, you have to stop, avoid. And there are invariably times when you encounter risks. And typically, these kind of sectors, only while they present the best opportunity, at the same time they also present best risk. And one has to be very careful in terms of entry and exit.
Okay, thank you very much for joining in, Vikas. Have a lovely weekend. We'll slip into a break. On the other side, we'll be joined by the management of CSB Bank to discuss their business.